just to recap, in the last episode, we were learning about the basic accounting equation and its assets, liabilities, and equity. Assets are things that you own and that they have value to the business, like supplies, equipment, furniture, a vehicle, etc. Liabilities are amounts that you owe to other people or other companies. So accounts payable if you've purchased things on credit, the bank, these are things called liabilities and things that you owe to other people. Now, what you own minus what you owe is your equity or net worth of the company. So let's begin to fill in some of these missing amounts for each equation. So first, we have assets, liabilities, and equity. Now I put an imaginary line down here so that we know that this equation is equal. This You can also rearrange the equation as assets minus liabilities is equal to equity, but for the purposes of today's lesson, I'm going to make it so that assets are equal to your liabilities plus your net worth. So it's pretty straightforward. All you have to do is solve for x. So if you have 24,000 in assets and 14,000 in liability, solve for x. X is equal to 24,000 minus 14,000, so this would be about 10,000. And all you have to do is make the equation equal, and these are the answers. Okay? Let me know if this makes sense. So 47,000 plus 40,000 is 87,000. 56,000 plus 110,000 is equal to 166,000. So I like to describe a balance sheet as a snapshot of the company, of the business. Everything freezes. Whereas a income statement is more like a video. An income statement is you're measuring performance over a period of time. A balance sheet is everything stops at the one point. And we usually do it as of the last day of the fiscal period. So let's say we are doing an income statement for the year ended December 31st. I would also make a balance sheet December 31st. Everything stops. And we look at our assets, liabilities, and equity, and we measure everything at that specific date and time. So it summarizes the information on the assets, liabilities, and owner's equity, which is the net worth. And it's a snapshot of how the business is doing on a specific day. And this is interesting to the investors, the government, the creditors, and the owners, because you want to know how much you own, how much you owe to which individual or company, and you want to know it at a specific time. So you're going to file a tax return, prepare financial statements, and it's all going to be based on this one specific date. So if you've ever seen TV shows or people who do inventory on a specific day, this is why. You want to be sure of things that you own minus things that you owe and do it at a specific date. And this sheet's balanced. And the reason why it's called balance sheet is because it reflects the accounting equation. Assets on one side, liabilities and equity on the other side, and it's perfectly balanced, as all things should be. So here are the rules of how to make a balance sheet. I'm going to assume that you already know assets, liabilities, and equity, and you have all of those numbers. So this lesson is going to be mainly focused on how to rearrange it and to prepare a balance sheet. So the first thing we need to do, like our income statement, is we need to prepare the heading. We have the name, we have the type of document, and notice we have a specific date, like an actual snapshot. Remember that in the previous example, we had it over a period of time because it was an income statement. Now this is a balance sheet, one specific time. So who, what, and when. So the first thing we do is when we prepare balance sheets, there's a few ways you can prepare it. You can have assets on one side, liabilities and equity on one side, or you can have it all stacked and have it vertical style. So for the purposes of this lesson, I'm going to prepare a basic one. So we're going to have an entire sheet, the heading, and then we're going to cut it down the middle, assets on the left side and liabilities and equity on the right side. So let's begin with our assets. The assets are things that we own and they possess value. So when we list all these assets, all we're doing is we're putting it in order of liquidity. Liquidity refers to how easy something is to be able to convert into cash. So obviously, when you see a balance sheet or a statement of financial position, they're the same thing. You obviously are going to see cash first because that's the easiest to convert to cash. It's just cash is cash. Accounts receivable is often next because accounts receivable reflects money that's owed to you. by your customers because they haven't paid you yet. So that's going to be very easy to turn into cash. Supplies and inventory are very easy to liquidate, but equipment, building, and land tend to be more fixed, and since they're harder to liquidate and to convert to cash, these are going to be put at the end. And if you go to more complex accounting, you'll realize and learn that these current assets, we call them current assets because they're expected to be relatively easy to be converted into cash. And these are called fixed or long-term assets because they're very hard to turn into cash. Inventory, I'd probably put it to current. Depends on what type of inventory it is, obviously. So these 4 things are current assets, and the equipment and building and land tend to be longer fixed assets. So we're going to put an underline, and whenever you see a underline in a balance sheet, this reflects you have to add these things. 1, 2, 3, 4, 5, 6 things. Add it, double underline at the bottom. So that's just going to signify the end of the column. So cash and accounts receivable are very liquid, whereas land and fixed assets are not. So our assets are done. Now we have to look at the other side of the equation, which is your liabilities and your equity. The liabilities are listed in order of maturity date. So maturity date refers to the how easy or when the liability is due. So if the liabilities are going to be due first, then this means that we're going to put it first. So accounts payable reflects things that we purchased from companies and we haven't paid them yet. The accounts payable, you could list multiple vendors. For my accounting practices, I like to just list everything into one column and just call it accounts payable. And these are amounts that are generally due very soon, perhaps within a month or two. And then the bank loan tends to be due earlier than mortgage payable. Mortgage payable is a very long-term fixed liability, and we're going to pay that off slowly. And a mortgage is a type of loan that you often take out if you buy a corresponding asset to it, like a house or some sort of property. So we have our total liabilities, and notice that for the total liabilities, there's no double underline over here because I'm going to add this 128,400 with some equity section over here. So the assets are on the left side, and on the right side is going to be liabilities plus a equity, liabilities and equity. So that's going to be on the right side. So to calculate owner's equity, you're going to have the name of the owner, and you're going to put comma equity, and this reflects how much equity this person has in the company, and then I'm going to add up the total liabilities and owner's equity. So this has to balance. So your liabilities and equity, when they're added together, have to equal the total liabilities and owner's equity. So here's what the final balance sheet is going to look like. You can have the liabilities and owner's equity below the assets and have one column. Then for the purposes of this example, it's going to be side by side. Assets on the left side, double underline. Liabilities on the right side, and then you're going to put total liabilities. You're going to add an owner's equity section. So this amount of 128,400 plus 91,200 is going to be equal to your owner's equity of 219,600. So that is how you prepare a balance sheet step by step. So you're going to have your heading, assets, liabilities, owner's equity, and everything balances. And this is how we know that the balance sheet is prepared correctly. So make sure that you also list a specific date for your balance sheet, and these amounts are accurate as of this specific date. So as you prepare the final financial statements and preparations, your bookkeeper or accountant is going to make sure that these numbers are accurate. So they're going to confirm that the 8,100 is actually receivable as of this date. They're going to count all the supplies, the inventory, the cash. So they're going to reconcile these amounts to make sure that it is accurate. Because an investor is going to make decisions off of this balance sheet. So you want to make this as accurate as possible. Here are some conventions when we prepare balance sheets. Make sure that you have a dollar sign at the top and a dollar sign for every total. There should be a dollar sign over here. And you have these totals over here. And make sure everything lines up and everything's spelled neatly. As an accounting teacher, one of the mistakes that my students often make is they often spell this account wrong. they spell it accounts receivable, but they mix up the I and the E. So you want to make sure that when you're sending something to your client or you're reviewing a balance sheet, everything's spelled correctly and everything is prepared properly. Let me know if you have any questions on the balance sheet, but I hope this helped you to understand how to prepare a balance sheet. And make sure to subscribe to my channel and for more future content. So just to recap, balance sheet, assets, liabilities, equity, everything balances, everything has totals and dollar signs, and this reflects the financial position of a business at a specific date. All right. So the next videos, I'm probably going to be doing some basic invoicing, how to create an invoice template, and then budgeting. Budgeting is very important for a small business to make sure that you have enough cash for your business. Okay. Have a great Sunday, and I will see you later. Okay. Bye bye.